Hi, everyone, and thank you for joining us today. For those of you that don't already know me, I'm Stephanie Hildebrandt, a partner with the BDC team at Eversheds. Today, we are going to be discussing the key differences between internally and externally managed business development companies. I would like to begin by introducing our panelists here with us today. First, we have Ira Penza, who is Managing Director at Wells Fargo Securities, leading the BDC and closed-end fund practice. Ira is very active in the BDC space and part of recent IPOs that we've worked with. Darius is counsel with Eversheds on the BDC team, and Meredith is also a partner with Eversheds in our benefits and tax group. Meredith works with BDCs on executive compensation matters, among other things. By way of background, as of August 2021, there were approximately 114 BDCs. Of those, 107 were externally managed and 7 were internally managed. So let's get started. Darius, can you start by walking us through the basic differences between an internally and externally managed BDC structure?
Certainly. Thanks, Stephanie. It would be my pleasure. We'll discuss the externally managed structure first and then the internally managed structure. In the externally managed structure, the BDC's day-to-day operations and investment activities, including its investment portfolio, are managed by an external investment advisor pursuant to an investment advisory agreement, subject to the overall supervision of the BDC's board of directors. In this structure, the BDC does not have any employees, and its officers are typically provided through an external administrator pursuant to the administration agreement. The investment advisor is typically structured as a limited liability company and must be registered as an investment advisor under the Advisors Act and have its own compliance policies and procedures pursuant to the Advisors Act. And serving as the investment advisor to a BDC, the investment advisor's services to the BDC typically are not exclusive, and the investment advisor generally may engage in any other business or render similar or different services to others. As mentioned, the investment advisor manages the BDC's investment activities and the investment portfolio pursuant to an investment advisor agreement, which sets forth the services to be provided by the investment advisor as well as its compensation. Under the 1940 Act, the investment advisory agreement, including any material changes to an existing investment advisory agreement, must be approved by the BDC stockholders and a majority of its independent directors. If there's a material change to the advisory agreement, the BDC will hold a meeting of stockholders to approve the amended investment advisory agreement. This requires filing a proxy statement with the SEC, which is subject to SEC review as it's not considered a routine matter proposal under SEC rules. Investment advisory agreements typically have an initial 2-year term and continue thereafter for successive 1-year terms if approved annually by the BDC's board of directors. And annually approving the investment advisory agreement after the initial 2-year term, the board will engage in a Section 615C process whereby it will consider a number of factors in determining whether to approve the investment advisory agreement, which will include the nature and extent of the services provided by the investment advisor, the performance of the investment advisor and the BDC, the AUM of the BDC, the compensation of the investment advisor relative to that of investment advisors to similarly situated BDCs, the projected expenses of the BDC, and the organizational capability and financial condition of the investment advisor. Under the 1940 Act, the investment advisory agreement must provide that it may be terminated by the BDC at any time without the payment of any penalty on not more than 60 days written notice to the investment advisor, and that the investment advisory agreement will automatically terminate upon its assignment, which includes a change in control of the BDC or the investment advisor. As mentioned, BDCs will also enter into an administration agreement with an external administrator for expense reimbursement purposes. No fees are paid directly to the administrator under this agreement. Instead, the BDC reimburses the administrator for costs and expenses incurred in connection with the services provided by the administrator. The administrator can be the same entity serving as the investment advisor or a different entity. Whether it's the same or a different entity depends on what's most structurally efficient for the client. Pursuant to the administration agreement, the administrator typically provides office space, equipment, and office services. Officers maintains financial records, prepares and manages shareholder reports and SEC filings, and generally manages the payment of expenses and the performance of administrative and professional services rendered by others. As mentioned, the BDC reimburses the administrator for the costs and expenses incurred in connection with providing these services. Sometimes we'll see these administrative services covered under the investment advisory agreement, such that the investment advisory agreement covers both investment advisory services and administrative services. However, this is not a recommended approach, as any material changes to the administrative services will require stockholder approval pursuant to the 1940 Act because we're dealing with an investment advisor agreement in this context. That said, the best approach is to have investment advisory services and administrative services to be provided under separate agreements, as the administration agreement can be revised without having to seek shareholder approval, unlike an investment advisory agreement. The term and termination provisions of administration agreements are typically similar to those of investment advisory agreements. In addition to this, BDCs are required to disclose the material terms of their investment advisory and administration agreements, including the amounts paid to the investment advisor under the investment advisory agreement and the amounts reimbursed to the administrator under the administration agreement in their SEC filings, which namely includes your quarterly reports in Form 10Q and annual reports in Form 10K, as well as in registration statements. Notably, for registration statements on Form N2, this includes detailed disclosure regarding the manner in which fees under the investment advisor agreement are calculated in various scenarios and the services provided by the administrator under the administration agreement. Now let's discuss the internally managed structure, which is quite different from the externally managed structure. Unlike an externally managed BDC, an internally managed BDC does not have an external investment advisor or administrator. Instead, the BDC's day-to-day operations and investment activities are performed by the BDC's officers and investment professionals, which are directly employed by the BDC. This is a primary difference between these two structures. Externally managed BDCs utilize external entities for their operations, whereas internally managed BDCs have direct employees managing their operations. As a result of having employees, internally managed BDCs are subject to extensive disclosure requirements regarding executive compensation. Since externally managed BDCs do not have employees, they are not subject to these disclosure requirements. Specifically, under SEC rules, internally managed BDCs are required to include compensation disclosure and analysis, commonly known as CD&A, in their proxy statements or annual reports in Form 10K. CD&A generally requires an internally managed BDC to disclose its compensation policies, practices, and decisions. In addition, internally managed BDCs are required to disclose all compensation paid to their named executive officers during the past 3 fiscal years, equity awards granted, vested, and exercised under equity incentive plans during the last completed fiscal year, the pay ratio of its CEO relative to its employees, and the material terms of any employment agreements. For purposes of this disclosure, named executive officers include the principal executive officer, principal financial officer, and the 3 highest compensated executive officers. For internally managed BDCs that qualify as emerging growth companies, the required executive compensation disclosure is scaled down. For example, they are not required to include CD&A in their proxy statements or annual reports in Form 10K. Disclosure of compensation paid to named executive officers limited to that paid in the past 2 fiscal years instead of the past 3 fiscal years. They're not required to disclose the pay ratio of the CEO relative to other employees. And the definition of named executive officer is limited to the principal executive officer and the 2 highest compensated executive officers. So in this context, the BDC discloses the executive compensation of 3 individuals as opposed to 5 individuals. In addition, under SEC rules, internally managed BDCs are required to include a say-on-pay proposal and executive compensation in their proxy statements for annual shareholder meetings. Generally, this is a non-binding advisory vote by shareholders on the BDC's executive compensation, which the BDC must take into consideration when determining executive compensation for the following year. Under SEC rules, shareholders must also be given the opportunity to vote on whether the say-on-pay proposal should be considered every year or every 2nd or 3rd year. This is known as frequency on say-on-pay. After the initial shareholder vote on the frequency on say-on-pay proposal, the BDC must then hold this vote on the 6th anniversary of the previous vote on this proposal. Internally managed BDCs that qualify as emerging growth companies are not required to hold a say-on-pay vote at annual shareholder meetings. Now, Stephanie, I think that sums up the primary differences between externally managed and internally managed BDCs.
Thanks, Darius. Now that we've covered the basics, are there regulatory consequences outside of the proxy disclosure related to choosing either structure?
Yes, there certainly is. In addition to complying with the disclosure obligations regarding investment advisory. Let me start over. We'll begin first by discussing those related to externally managed, and then we'll follow with internally managed. So let me begin again. In addition to complying with the disclosure obligations regarding investment advisory agreements and administration agreements we previously discussed, there are a few regulatory consequences discussed with respect to externally managed BDCs. First, an investment advisor to a BDC has certain fiduciary duties to the BDC, which are enforceable under the Advisors Act and federal and state law. These fiduciary duties dictate that the investment advisor conduct its business in a manner that places the interests of the BDC above its own. As fiduciaries, the investment advisor owes the BDC an affirmative duty of good faith, fair dealing, and full and fair disclosure of all material factors. This duty is particularly relevant to the extent an actual or potential conflict of interest exists. Any potential conflict of interest of an investment advisor or professionals should be promptly disclosed to the BDC. Similarly, Section 57 of the 1940 Act prohibits certain transactions with affiliates subject to certain exceptions and SEC exemptive relief. This issue most commonly arises in the context of a joint transaction or co-investment involving the BDC and its investment advisor. The level of restriction on the transaction depends on the affiliate involved and can be broken out into 1, transactions with control affiliates, and 2, transactions with remote affiliates. Control affiliates generally include any director, officer, or employee of the BDC, any investment advisor, principal underwriter, or person directly or indirectly controlling, controlled by, or under common control of the BDC, and any affiliate of any such person. Joint transactions, including co-investments with any of these persons, is prohibited under the 1940 Act, and exemptive relief must be sought from the SEC unless the BDC can rely on the Mass Mutual no action letter, which generally permits co-investments if no material terms other than price are negotiated. If Mass Mutual cannot be relied upon, then the BDC must seek exemptive relief to co-invest, which is relatively common and standardized in the externally managed space. Comparatively, transactions, including joint transactions with remote affiliates, do not require SEC exemptive relief. Instead, the BDC's independent directors can approve the transaction. Remote affiliates generally include any person that directly or indirectly owns, holds, or controls with the power to vote 5% or more of the BDC's outstanding voting securities, which is considered an affiliate under the 1940 Act. Any person that is an executive officer or director of such affiliated person, any person directly or indirectly controlling, controlled by, or under common control of any such affiliated person, and any person that is an affiliate of any director, officer, employee, investment advisor, or principal underwriter of the BDC. As mentioned, transactions with a remote affiliate do not require SEC exemptive relief, but do require the approval of the BDC's independent directors, including those that do not have a financial interest in the transaction, on the basis that the terms of the transaction are reasonable and fair to the BDC and its shareholders and do not involve overreaching. Now let's turn to internally managed BDCs. In addition to the executive compensation disclosure requirements we previously discussed, there are a few additional regulatory consequences of the internally managed structure to discuss. The 1940 Act generally permits internally managed BDCs to have an equity incentive plan that provides for the issuance of options, warrants, and rights to officers and employees, provided the BDC does not have a profit sharing plan. The 1940 Act expressly prohibits the BDC from having both an equity incentive plan and a profit sharing plan. These type of equity incentive plans do not require SEC exemptive relief, as they're expressly permitted under the 1940 Act. However, if the BDC desires to issue any of the securities to directors and or securities beyond options, warrants, and rights, such as restricted stock, then the BDC must receive SEC exemptive relief. Virtually all internally managed BDCs equity incentive plans provide for awards of restricted stock. Thus, SEC exemptive release is commonly sought. In addition, under the 1940 Act, shareholder approval is required to affect any equity incentive plan, regardless of whether the SEC exemptive relief is required. Notably, if SEC exemptive relief is required, the BDC cannot seek shareholder approval of the equity incentive plan until such relief is obtained. That said, the general approval process for equity incentive plans includes 1, board approval, then SEC exemptive relief to the extent required, and finally, shareholder approval. In addition, any material amendments to an equity incentive plan requires shareholder approval as well as SEC approval if the exemptive relief was previously received or is necessary to affect the amended plan. As previously mentioned, the 1940 Act prohibits BDCs from having both equity incentive plans and profit sharing plans. Therefore, a BDC must be careful with their bonus structure if it has an equity incentive plan. Specifically, if the BDC's bonus structure lacks an element of discretion, then it could be deemed a prohibited profit sharing plan. Thus, BDC should avoid formulaic bonus structures that lack an element of discretion. Further, under Section 12D3 of the 1940 Act, BDC is prohibited from owning a registered investment advisor. Therefore, if an internally managed BDC desires to expand its operations by forming and owning or acting as a registered investment advisor, it must obtain SEC exemptive relief. Under these circumstances, depending on the types of investments, the BDC may also need to obtain co-investment relief from the SEC. Stephanie, I believe this sums up the regulatory consequences related to an externally managed and internally managed BDC.
Darius, and we'll be going into executive comp and what that means in a little bit more detail in a bit with Meredith. But to change gears a little bit, turning over to you, Ira, how do you see, or how does the market view the difference between internally and externally managed BDCs?
Sure. Thank you, Stephanie, and thanks for the invite to attend this panel. And Darius, I know I'm not a lawyer. You guys are walking encyclopedias. So I can never be that, but that was a great overview, very helpful. So listen, this has been an age-old debate. What's the right, in the BDC space, what's the right structure, internally versus externally managed? And to Darius' point, he outlined there's pros and cons for both structures, right? Externally managed vehicles get the benefit of a scale of affiliation with a large asset manager or insurance company, the benefits of scale, more sponsor, deeper sponsor relationships, ability to originate larger transactions, infrastructure, back office, etc. On the other hand, internally managed vehicles, right, there is the cost benefits, there is embedded operating leverage, but also there is the platform and the people value, which is embedded in the vehicle, right? Exactly what Darius mentioned. People are employees of the BDC, and that's franchise, right? So definitely benefits of both. There was a point in time, I'm going back now 8-9 years ago, when investors used to pound the table for internally managed vehicles, right? They would emphasize operating leverage, lack of conflicts of interest, no conflict of interest between manager and shareholders, again, because employees, the management team is an employee and also an owner of the vehicle. I think that over time, the investor sentiment has changed, and there are a couple of reasons for that. First, the asset class and the BDC as a vehicle has changed significantly over the last 10 years, 10 plus years. The space is now institutionalized. The BDC vehicle is institutionalized. You see that more than 90% of the newcomers in the BDC space are large platforms, whether it's large asset managers, public or private credit managers, or managers affiliated with insurance companies. Aside, again, from the evolution of the right side and left side of the balance sheets, which have improved significantly. What we've seen is now, with the evolution of the space, investors have become a lot more balanced and open towards the externally managed vehicle structure. And a little bit history here, but 10 years ago, and Darius mentioned this, externally managed BDCs were almost like an island on its own, right? Because there were no co-investment, ability to co-invest across vehicles and other funds that the asset manager would manage, right? So the BDC was literally on its own island. Today, I think, you guys should correct me on this, but I think majority of the BDCs, externally managed BDCs affiliated with large asset manager, have received an exemptive relief from the SEC to co-invest across the platform. So now we're talking, this vehicle is really part of a big platform and gets the full benefit of that big platform. In addition to that, we've seen that some of the best performing BDCs have been externally managed BDCs. So investors are now accustomed to, get attractive ROEs from the externally managed BDCs. Second, for internally managed BDCs, it's very difficult to scale. It takes a long time. And it's also difficult to build franchise because it's really hard to do business out of just one vehicle. And obviously investors have noticed that, right? Third, we've seen, and there is mentioned in fee structures for externally managed BDCs have drastically changed over the last 10 plus years. They're long gone are the days of the 2 and 20 legacy fee structure. I think there is 1 or 2 remaining BDCs at the 2 and 20. So lastly, I think also big asset managers have behaved in a very shareholder-friendly manner. We've seen this especially during the pandemic, where they're waiving fees, providing revolvers, credit lines, committing capital, etc. So investors appreciate the benefits, again, being affiliated with larger platforms. Now, certainly there are a few large dedicated BDC investors who still pound the table for the internally managed fee structure, internally managed vehicles, but again, there are a lot fewer of those, and that's okay. Now, having said all of this, I do think the internally managed vehicle makes a lot of sense for specialist managers who have singular strategy, high value, high returning strategy, think venture lender, right? And Stephanie, you and I worked on a BDC. Actually, the last IPO post-COVID was an internally managed venture lender. We did it in January, Trinity. Investors like, right, both the ROE, the attractive ROE, and also the internally managed structure, which would give the ability of this vehicle, which was, I mean, it wasn't a big size, it wasn't large at all, but ability to grow their ROE to a very attractive level because of that operating leverage. So the IPO went very well. There was a lot of institutional demand for the IPO, and I have to tell you, just looking at the book again, reminding myself of the book, there were a lot of generalist type of investors who participated in the IPO, but again, also dedicated BDC investors.
And so you talk about, you know, the limit in size for internally managed BDCs and them being more specialized versus being on a broader platform. You know, Darius talked about the BDCs, the internally managed BDCs now seeking exemptive relief for basically operating a registered investment advisor. So they can, within the BDC structure, expand their platform. Do you see that having an impact on how the market looks at the differences between internally and externally managed BDCs?
I think that's a good thing. I think this is a very good thing because, again, to your point, there are constraints within the internally managed BDC structure to grow the vehicle. Having the ability to have a manager underneath the vehicle, and we have a few examples, and a recent one, I think it was last year, I think that's great, right? It helps with, you know, provides additional source of revenue stream for the BDC, helps the platform grow faster. For some, it provides an ability to, you know, originate larger transactions because they can split them between the balance sheet and the vehicle that they manage underneath the BDC. So I think it's a definitely good and creative way to expand the franchise and the platform, again, for internally managed vehicles, to improve returns and maximize value for shareholders.
Great. And it sounds like, and I think you alluded to this as well, but it sounds like investors are really looking at the ROE. They're not looking at the structure as much, where they're, like you said, there may be some that are pounding the table and want an internally managed structure, and that's important to them. But really, they're looking at the ROE. They're not looking at how things are structured. Is that right?
That's absolutely right. Yep, exactly. We reached a point, and again, back to 10 years ago, it was all about the dividend yield. Some BDC didn't cover their dividend yield, et cetera. Investors got really smart and obviously fully appreciate the BDC space today. And the biggest focus is it's all about performance. It's all about track record. It's all about, hey, does this manager, does this vehicle deliver strong risk-adjusted returns? And there are examples, right, of, I can think without mentioning names, internally managed BDC and externally managed BDC, both generating 11, 12% ROE, right? Both generating attractive ROE. So in my mind, the bottom line is still, am I getting the right ROE on a risk-adjusted basis and not so much the vehicle structure?
Great, thank you. That, I think, was helpful to add to Darius's lawyerly recitation, as you pointed out, Ira. So now we're going to turn to Meredith and give her a chance to talk a little bit here. You know, we've talked about the difference in structures. We've talked about how the market looks at those difference in structures. Let's drill down a little bit on the compensation, especially for internally managed BDCs. As Darius noted, it's all out there, it's public. You know, what do internally managed BDCs have to think about from an executive comp perspective?
Yeah, I mean, look, when you have employees in a public company versus in a separate privately held company, there are going to be pretty significant differences in terms of reporting. As Darius did a really great job mentioning, you know, there is this restriction on internally managed BDCs that they can either compensate management through performance-based compensation, which would include equity compensation, or a profit sharing plan, but not both. Of course, you can also do neither and just do cash compensation, but usually there is some interest in an internally managed BDC in equity compensation. And so as Darius did a great job of mentioning, that puts certain restrictions on bonus arrangements. It also puts certain restrictions, and it's kind of an unexpected place that we saw in a transaction we all worked on together, which was the 401k plan that had a profit sharing component, which, had to be restructured. So, it's one of those things that has to be, thought about from an administrative perspective. So one thing that internally managed BDCs like is the ability to have a share in the business through equity compensation. That is most frequently in restricted shares. We've seen some where they've done options. In order to do that, the SEC has said that if a BDC elects to pay an investment advisor performance-based compensation, they can't maintain an executive compensation plan otherwise permitted under the 40 Act. In order to issue warrants, options, voting securities, they have to be approved. The plan would have to be approved by the partners and directors of the BDC. The exercise or conversion price has to be not less than the value, the current fair market value, or the net assets of the securities, and the securities have to be non-transferable. So, I would think that that's something most of our internally managed BDCs are pretty focused on, the ability to grant executive equity comp and to have kind of a share of the business and interest in the business. I would have to imagine, Ira, that's something that investors like. I think the trade-off for that is that, you are part of a public company. And so not only are you subject to the general, disclosure requirements of the proxy that Darius mentioned, you're subject to 162M, which is the $1 million limitation on deduction limitation on compensation. And there have been some recent changes in the past couple of years on 162M, including the elimination of the performance-based exception, and also kind of, an expansion of the rules of, who's a named executive officer, including kind of once a named executive officer, always a named executive officer. So there is, some sensitivity about people having their compensation be publicly disclosed. The other couple of areas that, come into play are that internally managed BDC folks would also be subject to the 409A 6-month delay rule by being part of a public company, which means that, certain non-qualified deferred compensation might be subject to a 6-month delay in payout, which, sometimes people don't like when it comes time to get their money. They are also subject to the rules on clawback provisions, and the SEC is set to issue some new rules there. And they are also subject to 280G, the change in control rules. So, there's and obviously, privately held companies would be, but there's the ability to have a shareholder vote, a disclosure and vote process there to cure that, which would not really be available here. So, there's a couple of trade-offs for that ability to, get the equity compensation. And those would be kind of the main points to me on the internally managed piece.
Thanks, Meredith. Ira, when, again, back to the market perception, do investors pay attention to executive comp in, for internally managed BDCs at all? Or does it, like we talked about, just go back to ROE?
They do if the BDC underperforms. I'm not going to mention names. We know what happened with a few large internally managed BDCs that attracted activists, right, because of the underperformance. And then at this point, there is huge disclosure. Everything is disclosed, right? You have your base salary, your cash bonus, your stock award. Everything is in the filing on a historical basis, so you can see how it moves too. So if you don't deliver the right return, whether it's shareholders, board, or activist investors will definitely jump and start ruffling feathers. Now I would say that I think most internally managed BDCs also hire their compensation committees, and Meredith chime in here, they hire independent compensation consultants to make sure the compensation is in line with similar type of vehicles, similar type of companies. And again, there is also the caveat that there is, the stock piece and the cash bonus is tied to performance, right? You can see in the proxies target performance levels. So if you meet them, you justifies, large cash bonus at the end or a restricted stock award. So I think the disclosure, because there is so much disclosure, there is definitely a little bit more scrutiny around it, and boards and try to justify, make sure it makes sense how they pay the employees, specifically executive employees, what you guys call NEOs, right? Named executives. But at the end of the day, it's still, well, am I generating the right ROE? Is the price moving in the right direction? So.
Right.
One thing Darius mentioned, that the pay ratios, which I forgot to look at those, they do vary, right? There is one BDC is at 10x, the other one is at 33x, which huge range, and you see both because, hey, the one with the 33x pay ratio performance was fantastic, and the CEO did an amazing job of growing the BDC over the last 12 months, right? So nobody's questioning and saying, wait a minute, why is this one 33 and this one only 10, right?
Fair enough. Great. Thank you. And so, Darius, back to the lawyerly responses here, so let's talk about external advisors in comp, and we'll pull Meredith in here a little bit as well, but talk a little bit about limits on how the external managers are paid.
Yeah, certainly. So first and foremost, the 1940 Act prohibits issuance of equity of a BDC as compensation for an investment advisor. So as a result, you'll see that externally managed BDCs must pay the investment advisor in cash. In addition, the 1940 Act prohibits paying investment advisory fees and also having an equity incentive plan or profit sharing plan. So you also see that externally managed BDCs cannot have either of these plans. Further, as previously mentioned, the fees are pretty consistent in that you'll have a base management fee on assets and then an incentive fee on investment income and realized capital gains. And as previously mentioned, generally, historically, BDCs had a 2 and 20 structure, but that's kind of changed over time as the amounts have varied. And the incentive fee on investment income is typically subject to certain hurdles and catch-up features. And further, the realized capital gain incentive fee is one of the unique aspects of having a BDC, and that other closed-end funds are prohibited by the SEC from paying an incentive fee on realized capital gains. And those closed-end funds can only pay an incentive fee on investment income. Further, we see some variation in how investment advisory fees are calculated, as SEC staff hasn't formally taken a position on how the fees should be calculated, but does require extensive disclosure of how these fees are calculated, previously discussed. So, for example, you see some base management fees are based on total assets, while others are based on an average of total assets over a certain period of time. And some base management fees will exclude assets acquired with leverage, while others include as much. And cash equivalents are typically excluded. Similar concept applies to the incentive fees, and we'll see variations in how those are calculated and determined. Meredith, did you want to add anything additional to the compensation considerations for the personnel of externally managed BDCs?
Yeah, it's interesting. The equity piece is a real consideration. Most managers who think that, they are doing a good job want a piece of, kind of what they are managing. And so this prohibition on the BDC giving equity compensation to an externally managed BDC is something that we often get questions about from externally managed BDCs. How can we have some piece in this? And there are a couple of different things that we've worked with folks on. Obviously you can create a phantom plan that mimics the economics, either in terms of a non-qualified plan or some kind of, vest and pay arrangement where people are getting cash that reflects the growth in the shares over time. That obviously is going to be ordinary compensation, ordinary income, because it's a cash component. It's not a restricted stock piece where if you believe that there's still going to be capital gains treatment, going forward, you're going to be paying more tax on that. So that's something, that people sometimes struggle with. Another structure that we've discussed with folks is the concept of the externally managed BDC going out and buying shares of the BDC on the open market and awarding those shares, whether in the context of, just straight share awards or restricted stock, that is something that we've had a few folks explore. It can get a little complicated, especially if you're doing things like restricted shares, because do you buy the shares now, and then what happens if somebody forfeits? Do you then go sell the shares? You as the externally managed BDC are then kind of holding the hedging risk on that. Similarly, if you don't buy the shares until they vest, you as the BDC are kind of running the risk, if the external manager are running the risk of what happens if the value of those shares go up. Suddenly you're going out and paying more. And so you kind of have the external manager bearing the risk of the share fluctuation in value, as opposed to the actual, employee, which is kind of how you want it set up. So there are some complications there. We have not seen a ton of people do things like this, but we have had a lot of exploratory discussions, and we do have a few folks who have kind of moved to do something like this, or various schemes like this, to just, again, get as close as they can to that equity compensation piece that, those internally managed BDCs can do. So with that, Ira, compensation at the manager in an externally managed BDC is generally private. Does this mean there's kind of not really a market expectation in terms of what folks are getting or how that's being structured? Or do you think that investors are focused on that, even if it's not quite as transparent as those internally managed BDCs?
No, it's definitely a good point that you have no idea of the team that does investments and the CFO, et cetera, how much they're getting paid, right? Specific numbers, right? Because it happens at the manager. And if it's a public asset manager, there's scrutiny over there. What are the margins, FRE margin, fee-related earnings, et cetera. But the scrutiny is, again, optically, is what does the fee structure look like, right? And as we discussed here, it has changed significantly over time, right, for the benefit of shareholders. The base management fee of 2 is now 1.5 base management fee on average. That's kind of the predominant for the publicly traded BDCs. But we see a lot of people now adopting 1.25. And I'll tell you, you will see some people with 1% coming to market. So you definitely see a little bit more compression. And again, it's justified based, again, what's your business economics? What's your ROE model? If you're originating assets at L+4 versus, venture lenders at 12% asset yield, then there should be a different fee structure that's applicable to your vehicle. And on the incentive fee side, we've seen the incentive fee component being reduced, right, from the average 20. There are certain BDCs still at 20 to 17.5, right? The most recent BDC IPOs a couple of years ago, they all came out at 17.5. But people didn't really pay attention that the hurdle was also dropped. So it's easier to get paid that incentive fee, although it's a smaller dollar amount. So I do think the fact that things have changed, it means investors did pay attention, but you still don't know employee-wise, different people, who is getting paid what. And again, that, I guess it doesn't really matter as long as the right return is generated. Again, the CEO, CIO, who gets the lion's share of the fee and compensation, that's fine. It doesn't matter, I guess.
Thank you. I think we are coming to the end of our time, so wanted to thank everybody for participating. Obviously, there are still a lot more externally managed BDCs out there, but as Ira noted, there's at least one new internally managed BDC that came to market, and I would expect that there'll be further discussions about whether a company should be externally or internally managed. Obviously, if anybody has any questions about the material we've discussed, please feel free to reach out to any of us. Thank you to Ira, Meredith, and Darius for participating today. Thank you all for listening, and we hope you're enjoying the roundtable.
I have a question.
Oh, yes.
When are we gonna have this in person? I'm so tired of the virtual format. You're robbing the whole fun out of it.
I know. We are hoping, depending on how things play out in the world these days, we are hoping to do something in person in January. More to come on that. Again, just it all depends on how the world plays out.
Right.